Good afternoon, everyone. Welcome to the CCH Corporate Tax Managers Network event on employment taxes, obviously a subject of great interest. For those of you who I haven't had a chance to meet as yet, my name's Russell Evans. I'm Chief Executive of CCH across Asia Pacific. Before I pass over to our chair for today, Fiona Ritchard from Coca-Cola, I just want to say a few scene-setting comments. Firstly, in addition to the 250 people in the room today, 250 odd, not that you're odd, 250 people in the room, we've also got about 260 people joining via webinar. So put those two groups together. This is the biggest event we've run in the last 2.5 years. So just on that, if you're in the room and you've got a question in response to one of our speakers, if you can put your hand up, we'll bring one of our runners will bring a microphone over to you, and if you can just say your name, first name's okay, state the question, and then those on the webinar will be able to hear that, and the panel can respond to that. Similarly, if you're on the webinar and you've got a question, on the bottom right-hand panel of your screen, you'll be able to type in a question, once again, prompt for a name, and then type in your question, and that question then will then be taken up to the panel to review. Okay, back on the webinar, those of you who are looking at the presentation, you'll see the slides. You also have the ability to press the download button and get a copy of those slides. The people in the audience, you've got the slides in your pack, and we'll also be sending out a download for you to get a soft copy of those. Okay, now, next, final point. These events are run on behalf of the network members. So the presentation you're seeing today and other presentations we have run and will continue to run are based on the feedback we get from you as members of the network. So what I'd ask you to do before you leave, if you can fill out in your packs, so the people that are in the room, in your packs there's we welcome your feedback form, and we'd like to get your feedback, not so much on the quality of the sandwiches and the orange juice, but more so around the, although they were good, more so the feedback on today's session, as well as what other sessions you'd like us, or topics you'd like us to cover in upcoming events. Now, so we would appreciate, before you run out the door, I know we're all really busy, before we run out the door, the people in the room today, take 2 minutes to fill out that form. There will be security at the back of the door. No, there won't. Okay, and with that, I'll pass over to Fiona. Thank you.
Well, I'd like to welcome you all here this afternoon to the CCH Corporate Tax Managers Network Employment Taxes event. It looks like it'll be a good lineup of panel and speakers. Our first speaker this afternoon will be Glenn Smith, the FBT Risk Manager from the ATO, and he'll be followed by Ian Phillips from the Office of State Revenue in New South Wales. And following his presentation, we will have a panel discussion, questions, hopefully some from the floor. Thank you.
Thank you, Fiona, and welcome everyone who's come along today, and also those that are joining us by video. I'm giving an update from an ATO perspective on FBT, some of the things that have changed in the past year, some of the things that may be changing in the future, and also some things to watch out for when you're preparing and lodging your 2014 FBT return. First thing to consider if you're lodging a return is the due date for lodgement and payment of FBT returns. If you're lodging by yourself without a tax agent, that due date is the 21st of May for both payment and lodgement. If you're lodging through a tax agent, you may have a later due date. Tax agents are lodging returns who lodge returns electronically have until the 25th of June to lodge the return. However, the payment for those returns is still due on the 28th of May. If tax agents are lodging paper returns, the due date is the 21st of May. So if you're going through a tax agent, you need to liaise with them to see what sort of system they've got in place and when they want the information from you to prepare that return. If you do need extra time, there is an email address which you can request a deferral of lodgement and or payment. So take note of that if you think you're not going to meet the due date. Luckily, in comparison to some recent years, there haven't been a lot of FBT legislation changes this year. So That's not a lot new that you have to know about. On this slide, there's some reminders about some recent legislation changes which had some transitional provisions. First one of those is in May 2011, there were changes to the statutory formula method for valuing cars that were acquired after that date. And that's moving towards a 20% rate for all cars regardless of the distance travelled. For this year, the two rates that apply to these particular cars are 20% for those that travel 40,000 kilometres or less in a year, and a rate of 17% for those that travel more than 40,000 kilometres in a year. With the move to the 20% rate, there is common belief that there's no need to keep odometer records anymore. For this particular year, you will still need to keep odometer records if you've got one of the cars acquired after May of 2011 and the car travels more than 40,000 kilometres, you'll still need to keep the odometer records. You'll also need to keep odometer records for situations where you've got a car that you acquired before that date in May of 2011 and you're using the statutory formula method, and you'll also need to keep odometer records for any car which you're either using or contemplating using the operating cost or logbook method to value the car benefits. Living away from home allowances, there were changes which apply from October 2012. They included some transitional provisions for employees who were in a living away from home situation when an announcement was made in the May 2012 budget. Those transitional rules can apply only up until 30 June this year. So if you do have any employees in that situation, the concessions relating to those transitional rules will cease to apply on 30 June, if not before. Also, there were some changes made last year to the taxing of in-house benefits that were salary packaged. For those who aren't familiar with what an in-house benefit is, that's a benefit where an employer provides a good or service to an employee either for free or at a discounted price, and that good or service is something they normally sell to members of the public. For example, if a retail shop gives or sells at a discount some of their retail goods to some of their staff, that would be considered to be an in-house benefit. As I said, that last year the rules were changed so that you cannot salary package to receive the benefit of the in-house valuation rules, and there was some transitional provisions that apply only until the end of this month or the end of the current FBT year. So if you are in that situation, make sure that if you've got employees that are eligible for those transitional rules, that you've got all those benefits and transactions finalised before the end of this FBT year. There were a couple of proposed law changes that are not going ahead. So you may have read about them in the paper in the last 12 months and wondering what's happening with them. The first one was a proposal to phase out the statutory formula method for valuing car benefits. That proposal is not going ahead, and the other one that's not going ahead relates to a proposal to limit the individual deductions for self-education expenses to $2,000 per employee per year. That was going to have a flow-on effect to those benefits that may have been provided by the employer to the employee, so in the FBT realm. But because that change is not going ahead, you don't have to worry about that $2,000 limit either. Some areas to watch. Firstly, for those employers providing living away from home allowance or LAFA. Some things to consider is as a result of the law changes from October 2012 is that if you're claiming reductions to the taxable value of LAFA amounts, you need to ensure that the employees meet all the conditions necessary to be eligible for those reductions. Secondly, we've seen some cases whereby employees were calling an amount LAFA or living away from home allowance before the law change, and they're now calling the same payment a travel allowance. If you're in that situation, you need to be very careful, and you need to make sure that the employee is legally travelling, and if you're unsure, you're best to apply to the ATO for a private binding ruling about that issue. Correct declarations. With the new law, there are now 4 declarations that apply to living away from home allowances depending on the individual employee's circumstance. And it is quite possible that the employee may have to fill out 2 of those declarations. So make sure you look at the 4 declarations on the ATO website and that you have got all the required declarations from the relevant employees. Appropriate substantiation of employee expenses. After the changes, employees are required to substantiate all their accommodation expenses, and they're also required to substantiate their food or drink expenses if the amount that they're spending does exceed the Commissioner's reasonable amount. And for the current year, for a single person living away from home, that's $233 per week. Tax equalisation payments relate to situations whereby an employer brings someone from overseas and they may work for an associated company overseas. And they're employed on the basis that when they're in Australia, their after-tax salary remains the same, which could be regardless of the fact that Australia may have a higher individual tax rate than what applies in the home country. So what employers do in that situation is they may either gross up the salary of the employee when they're in Australia to allow for that, or alternatively they may wait to the end of the year, and when the employee gets their Australian income tax bill, the employer may make an expense payment benefit relating to that. Some of the things we've noticed here are employers are getting those two methods confused, and they may be either underpaying or overpaying tax. And secondly, what we've found is that in employment agreements, etc., the treatment of that particular issue is overlooked quite often in those agreements. So it is important that if you do have employees in that situation, that you have got the documentation to support the method that you're using. Entertainment, a couple of things that we've found when looking at employer entertainment records, particularly in larger organisations, that the people involved in doing the tax return preparation may have a good handle on classifying items of entertainment and what sort of documentation needs to be kept around entertainment events. But when that becomes decentralised, we often find that those checks and balances aren't in place further down the line, which makes it harder for the people preparing the return to come up with the right answer for the amount of tax that needs to be paid on entertainment. Also, for entertainment, there are 2 exemptions that get a lot of things out of FBT. The first one is the minor benefit provision, which means that a benefit valued at less than $300 provided on a minor, infrequent and irregular basis, and also meeting certain other conditions, may be exempt from FBT. The second exemption relates to where a function is held on business premises on a working day. Food or drink provided to employees but not to associates may also be exempt under those provisions. Whether you can apply one or both of those exemptions depends on your income tax status and also the method you choose to value your meal entertainment. So when you're making those elections as to which method you use, you need to make sure that you're not incorrectly applying those exemptions when you shouldn't be. An example is when you're using the 50-50 method to value meal entertainment, you can't avail yourself to either of those exemptions. If you're using the actual method and you're an income tax paying employer, you can use both of those methods, but you do need to look at the ATO publications to make sure you're getting that right. In relation to car benefits, we're seeing some issues with exempt vehicles, which are commercial type vehicles, utilities, vans, trucks, etc. There is an exemption available for the private use of those vehicles only if the private use is limited to home to work travel and minor, infrequent and irregular other travel. We have found instances whereby the employer is just giving the employee the keys to one of these vehicles without giving them any instructions on limited private use, and as a result of that, they're finished up with an FBT liability. So it is important if you're relying on that exemption that you have procedures in place so that employees know the limitations, and you also have some sort of check to make sure that the employees aren't using them from those vehicles for additional private travel. Another issue we find is for those employers using the operating cost or logbook method is that you're required to estimate the number of business kilometres travelled based on the overall usage pattern, not just relying on the percentage that you get from the logbook. An example might be you keep the logbook for a continuous period of 12 weeks and you come up with a 80% business use percentage. But later in the year, the employee may take annual leave and take that car on a trip around Australia. In that case, you need to adjust the business kilometres travelled to reflect the fact that the car has had extensive private use outside of the logbook period, and the private use percentage would go up from 20% to something else. What the ATO is focusing on relating to compliance, which means audits or reviews, firstly we're looking at late lodgement of returns. We found that a lot of employers were not meeting the deadlines to lodge their returns on time. So last year we undertook a big activity to send letters to and also contact a large number of employers, which means that this year a lot more employers, if they do lodge late again, will be receiving failure to lodge penalties, which can range from $170 for smaller entities up to more than $3,000 for larger entities. So it is important, if you're not going to meet the lodgement deadline, to contact the ATO before that date to request an extension of time to lodge a return. Also, we find a lot of employers should be registered for FBT, but they're not. We do some data matching based around things like motor vehicle registration data to identify cars bought under business names, and check that against FBT and income tax return data to see whether those particular employers are doing the right thing or the wrong thing. Given that you've come along today and you're showing enough interest to come along today, your businesses are probably not in that situation, but we do chase that sort of thing up. Correctly applying the new living away from home allowance laws, we've covered that in a bit more detail in a previous slide. And also we find that there's problems where you've got the small companies where the shareholder directors are working in the company. They're paying some private expenses through that company bank account, and they're not acknowledging those expenses for FBT purposes. In the packs that you've got, there are copies of these slides. There's also some additional slides which I haven't covered today due to the short period of time I've got to speak. They cover things like the fact that the FBT tax rate will increase from 46.5% to 47% from 1 April this year. So it won't affect the returns you'll be preparing soon, but it will affect the following FBT year. Another way you'll notice the effect of that change is when you receive, for those of you who pay FBT instalments, when you receive your June activity statement, you will find that the instalment amount might be roughly 2% more than what you expected. The reason for that is because the FBT rate is increasing, and that change is to reflect that increase in the FBT rate. So if you're trying to match that up and it's not quite there, there's no need to ring the ATO. That's the reason why the instalment amount will be different. The transitional car statutory formula rates, I talked about those a little bit, and in the handouts there is a table which shows the rates for this year and next year, and also some previous years. ATO FBT consultation. We had a forum in the ATO called the Fringe Benefits Tax Subcommittee of the National Tax Liaison Group. That committee was disbanded following the August 2013 meeting. That was as a result of a review of all forums conducted by the ATO. The number of forums was reduced from more than 50 down to 8, and the FBT NTLG subcommittee was one of those forums that's disappeared. If you have in the past submitted items to that forum for consideration by the ATO and externals, there is another way that you can still do that, and that is by going to the ATO website and looking at details of our consultation hub. In the handout there is a link, or there's some directions on how to find that page on the ATO website, and you can go to that page and submit any items which you think need wider discussion. Also, there are details of some ATO phone numbers if you've got any FBT inquiries, and also some other inquiries. And the last thing on this slide is the web address for FBT content on the ATO website. So that's all I want to cover at the moment, and there will be opportunity, if anyone's got any FBT questions, to ask those later.
Good afternoon, everyone. As you know, I'm from the Office of State Revenue, and like everyone else from OSR, I'm here to help. We treat our taxpayers and their advisors as clients, and even if they don't like it, we call them clients. But we're also your clients because we rely on the information you provide and also the payments you make. And like every other business, our clients aren't always right. We are also not always right, which is why we have objection and appeal provisions. Before I start on the first slide, fringe benefits, just some introductory remarks about payroll tax in New South Wales. The current tax rate is 5.45%. The threshold is $750,000. There hasn't been many changes to payroll tax legislation in recent years, not since harmonised legislation was introduced in 2007. With the threshold, while the New South Wales threshold is $750,000, it is essentially a threshold for Australian wages. So if you pay wages in more than one state, then the threshold in New South Wales will be reduced to the proportion that your New South Wales wages represent of your total Australian wages. So if you pay $1 million in Australian wages and $500,000 in New South Wales, your New South Wales threshold will be half the $750,000. Just dealing quickly with fringe benefits. Like anything else that is remuneration, it is subject to payroll tax. We mirror the Commonwealth provisions as far as we can. Effective salary sacrifice arrangements mean that you pay tax on the net salary and wages, and you also pay tax on the fringe benefits. You pay on the aggregate fringe benefits amount for both type 1 and 2 benefits, but they are grossed up by the lower of the two rates, and that is designed to give you an effective after-tax rate which is consistent for both types of benefits. And we follow ATO rulings and advice. If we do an audit and discover that you haven't paid the correct fringe benefits, then our auditors will generally ask you to correct your ATO return, and then we will pick up the same figure. And of course, penalty and interest can apply. The common mistakes, the most common is people forget to include fringe benefits. In some cases, they lodge a return and they don't show fringe benefits, but they actually have returned it in their gross wages. And that's a mistake because our auditors will pick you out thinking you haven't returned fringe benefits and do an audit, and then pick you up for something else. The other common problem is failure to apply only the type 2 gross up factor, so in fact people sometimes overpay, and we do make refunds despite what people sometimes say. Contractors. This is probably the biggest area of conflict we have with employers. We have relevant contracts which are subject to payroll tax. The relevant contract is defined very broadly to include any contract for service, and it includes contracts for a result. And then a series of exclusions which are designed to remove those contractors who provide services to other employers during a year. Or essentially are independent and have their own business. The most common exclusions are where a contractor works for less than 90 days for the one employer in a year, or where they're providing the services under the contract using two or more people to provide those services. Contracts for the conveyance of goods are excluded. So owner drivers, also insurance sellers and door-to-door sellers. Where, particularly in the building industry, a contract payment includes non-labour components, we do allow a deduction. We've issued a number of rulings specifying percentage of payments that we will allow you to exclude without providing evidence in particular industries. They are all in the building industry. If you're not one of those categories, then you have to, if you want to claim a deduction for a non-labour component of a payment, you have to justify it and essentially seek a ruling and provide evidence. The evidentiary burden is on the client, especially in claiming a contractor deduction. Payroll tax is a self-assessment tax, so you're expected to correctly lodge your monthly or annual return if you're an annual taxpayer and pay the correct tax. And when we do an audit, you should have sufficient evidence to convince us that if you've claimed an exemption that it is justified. The problem with contractors, of course, is that they are often independent businesses, and they're not necessarily going to share information with you, but if you're unable to provide evidence, we do have the capacity to check things like tax returns of the contractor and work out whether, for example, the information they provide to the tax office indicates that they are using two or more employees in their business. The anti-avoidance provisions are also applicable, and we have had employers who attempt to attract the exemptions under the relevant contract provisions by some artificial arrangements, including reversing the way in which payments are made. But we will apply the anti-avoidance provisions in those cases, and we have done so. There is often a failure where someone declares contractor payments to not declare also superannuation contributions, where there's a requirement to pay superannuation under the Superannuation Guarantee levy legislation. There are also instances where employers may employ someone as a common law employee but insist that they create a company to receive their payments, and those arrangements don't work. With, in the case of an audit where we assess someone, the penalties can range from ordinarily 25% for failure to take reasonable care up to 75% for intentional disregard of the law. Employers who make a voluntary disclosure before we send them an advice that we've commenced an audit, and provided they provide sufficient information for us to assess them, will incur no penalty tax, but they will incur interest. They will incur both the market rate, which is just under 3% at the moment, plus an additional 8%, which consists primarily of a penalty. In circumstances where failure to pay tax correctly or on time was outside the employer's control, then the penalty tax, if it has been imposed, may be remitted, and also at least the penalty component of interest may be remitted, but the market rate generally won't be. This employment agency provisions have become an issue in recent times. Under the employment agency provisions, an employment agent is liable for payroll tax on the wages that they pay where they procure either an employee or a common law or a contractor for a client, an end user. The exclusions under the contractor provisions don't apply. So if someone works for the employment agent for less than 90 days, or is procured for the end user for less than 90 days, the exclusions don't apply, and the wages are taxable. The big issue is that employment agents are liable on ordinary wages paid to their own employees if they provide those employees to an exempt body. The exclusion for contractors provided to an exempt body doesn't apply. So, for example, a hospital where the employment agent procures nurses who work for the hospital, and they become employees of the employment agent, those wages will be liable for tax. Employee share schemes, again we piggyback on the Commonwealth provisions to a large extent. Payroll tax is paid on the value of the shares or options less the consideration. Unlike the Commonwealth, we give employers a choice of paying on the initial grant of the shares or options, or when the shares vest. If an employer chooses to pay on the grant of options, and the options are subject to conditions, and the conditions are not met, then and therefore the options are withdrawn. If the employer has paid payroll tax on the initial grant, then they can deduct the amount they included in their initial return from the return they make when those options are cancelled. But if the options are simply not exercised, then there's no refund or no credit allowed. The Commonwealth valuation rules apply both to options and shares. It's fairly straightforward with listed options and shares. It's the market value on the at the time of the grant, or vesting. In the case of unlisted shares and options, the valuation rules under the Commonwealth legislation apply. The real risk of forfeiture test, which applies in the Commonwealth legislation, doesn't apply for the purposes of determining when the employer becomes liable. One of the common mistakes is that there are Commonwealth exemptions, such as small amounts, less than 1,000, I think, are not taxable under the Commonwealth provisions. They are subject to payroll tax. And the general rule is that if FBT applies to a share issue or an options issue, then the FBT value applies for payroll tax purposes. And if the Commonwealth employee share scheme provisions apply, then that's the value for payroll tax. Employee superannuation contributions. The employer superannuation contributions. The twist here is that I guess this applies not just to super paid to employees, but also to deemed employees, contractors, which doesn't happen very often, but it can happen, and also to directors. Contributions in respect of services provided before 1 July 96 are exempt, but this generally only applies to the old defined benefit schemes, many of which have closed, but they still do have, there are still a number of large schemes. The biggest difficulty here is that the employer must keep evidence of the calculation of the amount that of contributions that relate to pre-96 services. And that often requires a certificate from an actuary. Second area of difficulty is that actuaries don't always agree. So the employer's actuary might come up with a different result to the actuary that we employ if we have a dispute. There are some other things that are not on the slides that I'll just mention briefly. Pardon? Okay, I won't. Thank you.
Thank you, Glenn and Anne. I'll give Anne a bit more time at the end if the panel doesn't use up all their time to make those last comments. Thanks, Glenn, for a great presentation, a timely reminder that some of those transitional rules are now coming to an end, and thank you, Anne, for your insights into what employers get wrong from a payroll tax perspective. I do have a couple of questions. This wonderful world of technology we live in, someone on the webinar has asked a couple of questions, so I'll ask those questions first. The first question's for Glenn. So in relation to private use of exempt vehicles, you mentioned that employers aren't checking the private kilometres. What is the ATO looking for in that respect? Are they looking for employers to be keeping logbooks, or is it a declaration by the employee who drives the vehicle stating that their private use is minor, infrequent and irregular enough?
Okay, thanks for that question. The law doesn't require you to either keep declarations or a logbook. What we would like to see is some sort of policy in place to show that employees are advised of the limited use. A declaration would also be extremely useful if they're signing at the end of the year to say that they know about these limitations and they've complied with them. Some things that employers need to be careful about in relation to this exemption is that if the vehicle has got toll road trips, speeding fines, etc., at a time of the week when it really shouldn't be out, that can cause trouble for them. And other things that we've seen are examples whereby the employee may have a caravan or a boat and the only vehicle with a tow bar on it is one of these exempt vehicles. So there's some pretty obvious examples of where you can fall foul of that. But generally, you do need to give the employee instructions, and a declaration at the end of the year would be useful. Would only be in very limited circumstances, if at all, that you would want to keep a logbook to support that statement.
Great. No, thanks, Glenn. That's good. Good tips for us.
Would you expect to see, though, a policy in place that's being enforced? Would that be your starting point if you're going in to have a look or do the audit?
Right. Yeah, you do need to have a policy, and if you can show evidence of where you've enforced that, if, for example, you found an employee has been using the vehicle incorrectly and what steps you've taken in relation to that, any monitoring you may do of odometer records, etc., petrol purchases, that sort of thing would also be useful.
Thanks. Great. Thanks, Donna. The other question is from the same person on the webinar, and it's quite an interesting question because obviously with the FBT rate and the income tax rate changing at different times this year, they've asked, well, how does that impact payroll tax and the gross up rate for payroll tax return purposes?
Well, the gross up rate has gone up by about 0.002, I think. We've issued a ruling, I think it's number 3, which specifies the gross up rate. That will apply from the time the FBT, that will go up from the time the FBT rate goes up.
Great. Thanks, Anne. Now over to the panel or to the audience. Do you have any questions?
We've been saying to people, especially if you've got an income tax exempt body or if you've got people that are doing the thresholds, just be careful because the gross up rate will increase. So if you're from an organisation where people package up to their $17,000 or $30,000, just to make sure that they are aware that the amount they can actually package now will be slightly less because that type 1 rate will increase. And then on the flip side, there is some packaging as well for a little bit where people are packaging full FBT items because, you know, it's cool to do so. Or that they're in that top tax bracket. For those 3-month period, it will actually be cheaper for them to do that through income tax than it would be through FBT. So it's just some things to keep in mind.
It's John here. I've got a question for Glenn. I'm the CFO for an organisation that spends an awful lot on entertainment, very high volumes across multiple staff. And our biggest concern with FBT compliance is the small and infrequent exemption and the fact that the ATO appears to refuse to give any guidance and just say, well, it's up to you to interpret. A common English sentence which just says small and irregular. Any comment on that? Any guidance? Any reason why the ATO will not provide guidance? Thank you.
Yeah. One of the things with that is when we're looking at numbers, it depends on the benefit type, the circumstances for why the benefit was provided, and also the amount. So there's a number of factors that you need to consider, and then on balance for a particular employee to say it's reasonable to treat these amounts as minor. And that's the reason why, because you've got those balance of factors, that if we were to say that 5 benefits was okay for everything, maybe it's not if it's entertainment and they're $280 each. And that's the reason why that we haven't got a set of guidelines to say that X number of occasions or a total amount of Y dollars for all the benefits will be okay, because it can vary according to the benefit item and also the need to give a benefit item. And a simple example of that might be if you're requiring someone to work overtime and you're providing them with taxi travel home, then that's really something you're providing for a business need. Whereas if you're providing someone with a restaurant meal at night time, there's no real business need for that, and that would be treated differently as well. So I know that's probably not helpful to your question, but
I think a sort of adjunct to that is part of the rules, if you like, is indicates that the more sophisticated your systems are, so the better you are able to differentiate, the more likely you are to be caught by the FBT. So there's actually one of the legs of the test which sort of gives you a bit of a easier route to pay less FBT if it's not really practicable to identify who received which benefit. So there's almost a perverse sort of outcome where the better you are at keeping track, potentially the more FBT you pay.
Yeah, that is true, although the law wasn't designed for it to apply that way. Might get some comment from some of the commentators as to practically when they're preparing FBT returns, some of the things that they consider.
Yeah, and we've done some work around this as well, where we say to people, look, if you're not using the 50-50 and you do use that actual method, then start looking, it does come down to your general ledger, try and classify it as well, make sure that people are putting the information into your expense systems are very clear at what's in, what's out, try and separate your sustenance. But we always say just look at employee groups. So if you know that you're doing Christmas party and everyone goes to that, then you pretty much know you're doing it once a year or into financial year parties, because we're all accountants and tax, we like those better than the Christmas parties. Then they're the types of things you can do minor for. But then we say, look at those types of people. If you've got the CEOs or CFOs or your sales and marketing people that are going much more regularly, then those are the type of people that you would probably say, look, it's probably a function of their job. Is it really when they do entertaining, minor and frequent? Probably not. That comes to the problem, though, and we find this from a practical perspective where people really struggle, is that because it's not a reportable fringe benefit, people don't necessarily put down, they might say 5 employees and 2 clients or vice versa, but you don't actually have employee names. So how do you know if one person's going to something every month, or if they're only going to something once a year? It's all right if it's a small organisation, but when you look at us, EY, I think it's got 6,500 employees. I couldn't tell you if someone in the audit practice was going to a meal every day or whether they were going once a year. So I think that is one of the complexities that really need to work around. I guess it's understanding what sort of functions there are and what's going in. But it is a really hard question, and we get it a lot through FBT season, or actually throughout the year.
I think we've been getting that question for years, actually.
Yeah.
And I think the only thing I can add, and I agree with everything you've said, is that it really depends on the risk appetite of the organisation as well. I'll have clients that will just be really tight. We might only allow 1 or 2 or even 3 or 4, but others that might go up to 20 or 30, just depending on what the actual expense is and how much it is. So unfortunately, it's not an answer to say it depends on risk appetite, but it really, really does. And I guess at the end of the day, where you've got a high dollar value, in your case, you may have to really decide whether you want to risk it and use actual, or take the safer route and go 50-50.
What's the ATO's, if and when an audit occurs, what's the ATO's stance with respect to this sort of assessment? So if somebody's made an assessment that 20 for a particular class of employee is not frequent, so is infrequent, 20 lots of $30 or something, we're saying, okay, we're going to exclude that. ATO comes in, does an audit, comes up with a different interpretation. Is the ATO going to sort of say you were reckless, or are they going to say, well, it was reasonably argued, but we disagree, therefore we'll extract the extra tax, but we won't go for penalties and interest? Is there any sort of guidance on that?
Yeah, what I would suggest in that case, if you put a lot of work into it to come up with amounts that aren't too far off the mark, also if you sought some advice on that, I would like to think the ATO would say, maybe you've been a bit generous this year, get it right next year, and give you some guidance for next year. If you're way off the mark, then potentially they might adjust the back year and possibly look at penalties, but you'd have to have it completely wrong, I think, for that to happen.
And just turn your name tab around so Glenn can't see it.
Exactly.
Okay, I've got another couple of questions from the webinar members, participants. The first one's an easy one, but I'm not going to answer it. Is salary sacrifice novated leasing still available to employees?
Absolutely. Nothing's changed.
It's actually interesting, sorry to monopolise, but we were doing work with one of the salary packaging companies, and it was interesting that they said that actually salary packaging on novated leases are now increased, because even though it was quite wobbly there, I was going to say the wheels fell off, but probably a bad pun, even though it was a bit wobbly there for a while, a lot more people are going, oh, what's this tax concession? If they wanted to take it away,
yeah, it really highlighted
I should be doing it. So we're getting a lot
the ability
more
to do it when the Labor government tried to get rid of it. Now everyone knows you can do it, so...
And they want to know why they were going to get rid of it, so it must have been good, we need to do it now. So it's been interesting.
And just to give some stats, cars are actually the most packaged benefit in Australia, so it's still happening.
And the next one is, sorry to interrupt, when you're looking at a 5-year service award, can I provide a $250 gift voucher and use the minor benefit rule?
Yes.
Great. Thank you. Any more from the audience?
Hi, Elizabeth. I've got some questions regarding payroll tax. I know a few years ago all the states went down the path to harmonisation. Has it ended there, or is, because I think there's still a few things that are different in each state. Has it ended there, or is there will there be a continuing harmonisation going forward?
Harmonisation has been a moving feast. The original intent of harmonisation was to harmonise the definition of wages, and that's largely been done. 6 of the 8 jurisdictions now have template legislation with which define taxable wages and many of the exemptions in identical fashion. But there are some still minor differences, particularly in exemptions. Some of those differences are because of different systems in the respective states. For example, with apprentices, Victoria provides an incentive for apprentices which isn't related to payroll tax, so there's no exemption for payroll tax. And New South Wales has also removed the exemption but provides a rebate which is paid for employers who pay payroll tax. And there are differences between the states. Some provide exemptions, some provide rebates. There is no harmonisation in terms of rates and thresholds, but that was never the intent. Those are now, will continue to be set based on the revenue needs of the particular states. When we get an adverse decision that perhaps disrupts the policy intent, then we do consult with all other jurisdictions about changes. And in Victoria, for example, they have recently amended the provisions relating to owner-drivers to limit the relevant contract exemption to contracts where the contract solely provides for conveyance of goods. And that flows from the Smith's Snack Foods case. The other states are also looking at those amendments, and I guess it will be up to each jurisdiction, each government, to decide whether they follow the Victorian lead. Victoria also amended the provisions relating to charitable bodies or not-for-profit bodies to try and limit the exemption for workers who don't carry out charitable activities. And the other states are looking at those amendments also, but most of the states are waiting for the Commonwealth review of not-for-profit bodies to be completed before they act.
Okay, I've got one more question. A few years ago I went to an SBR conference where I think it was Treasury was presenting that it was the way of the future, and I know that the ATO has embraced SBR reporting. How is payroll tax or the departments in the state departments, are they also looking at SBR reporting as being the standard that we should be looking at?
Well, I think we have one client who lodges using SBR.
It's us.
Yeah. The difficulty with SBR is that it doesn't provide an avenue for payment at the same time as you lodge your return. And so you have to make a separate payment anyway. And also some of the software hasn't yet been developed by some companies, but with the ATO or the Commonwealth announcing that in future all payments will have to be made via SBR, I think there is probably some prospect that it will be picked up by more employers. It's available, and some employers, more than one, actually use it to validate their return, but it's not used very much at all.
Great. I've got a couple more questions from the webinar participants and one of my own as well. I've got lots more questions. Actually, they're streaming in. The first one is a corporate sporting team entry FBT liable? So I assume that it's more than $300, but probably not per participant. Would someone from the panel like to answer?
Well, it really depends on how many of these they have, but I would say no at the first instance if it's just a one-off, or if they have a few teams, but generally no.
Minor benefit.
That's good, Tom.
Okay, the next question is, where you have a sponsorship, so you might sponsor a sporting team, there will often be commercial reasons, banner advertising, those types of things, but often there are free tickets associated with the sponsorship. What's the treatment of the free tickets?
Yep. So the free tickets are either classified as property or residual fringe benefits, and because they're provided on a non-arm's length through a non-arm's length transaction, they will be. You do need to use a notional value, which is just generally a market value. And we've got a lot of clients that have these types of sponsorship agreements. And generally, with a sponsorship agreement, a company would pay, say, $100,000 to sponsor, I don't know, the South Sydney Rabbitohs or whatever. And with that, they will get the, sort of bragging rights, as well as, 10 tickets to the grand final and a table at an event that they've gone to. So there's lots of little bits and pieces that come out of a sponsorship agreement. And so you do need to be aware, for those of you that prepare the FBT returns, you need to know what you are getting as part of that sponsorship agreement. And then once you identify what events and what sort of tickets you're getting, you then need to put in place a system where you can actually find out who took what, which employee used which bit of it, whether they got tickets or went to the functions, and then determine from that point, what is a recreational, what is, and maybe even if the minor benefit might apply the minor benefit exemption.
And further on that, sometimes there are now these money can't buy experiences in sponsorship agreements. What's your view on the
notional value? Notional value.
Money can't buy it.
We get it a lot in practice too when you get to the FBT year and they say, oh, look, we know we had these 10 tickets, but we have no idea who got them and where they even went. So quite often they go unreported, which then you mean you're getting some inconsistencies. And I said, it's okay because the tax office really can't tell or can't time back the reportable fringe benefits back to your FBT return. But it is that risk that if you do get audited and they come through and say, why is all this unallocated? We didn't have sufficient records to know who actually even attended.
But they can charge $1,100 per payment summary that is wrong. So if they can see that you haven't allocated 10 tickets, automatically 10 payment summaries are going to be wrong. So, there is a domino effect, and I think it's really important point around recreational entertainment to make sure that you are keeping adequate records when you're handing out tickets to events and stuff like that.
And I think part of the problem is allocating responsibility to a particular team or a particular person, whether it's the events team that is responsible for managing all of those corporate events, because it is right, you do need to track it, because there is scope to apply the minor benefit exemption. But as Kylie mentioned earlier, if it's the sales and marketing people that are going to the corporate box events every single match, then there might be you might be less inclined to apply the minor benefit exemption in that case.
Another one is, I heard that the ATO has a view that if a gift card or a voucher is used for a staff reward or incentive, i.e. staff can expect that if they achieve the target or meet a certain requirement, that in that situation you can't apply the minor benefit rule, so that's within the ruling, but I'll let the panel answer that.
Correct. That's correct. Yeah, the ruling does actually say that to use the minor benefit exemption, it can't be a reward for services, so it can't be something that's linked to a KPI. So if an individual says, if I do X, Y and Z and I'm going to get this, then even though it's the $250 gift card, it's under the $300, it still doesn't satisfy the minor rules.
So you need to make a distinction essentially between whether it's a documented incentive plan that has key targets and KPIs that are achieved versus maybe an ad hoc employee of the month where the employee doesn't know what they need to do to receive the benefit. You need to be able to make that distinction.
Just on your point there about service incentives, but I think you mentioned earlier if it's a service award, that was okay.
Service award was long service award.
Yeah, I just sort of had
I
had the understanding that we thought that it would go along with that category because it was an award for your service.
It was a 5-year service award, not
that's a long service leave award.
Yeah, okay.
Different.
So if it's under 300 and it's a long service award, you'll make a distinction between that and, you know, the other typical performance award.
Yeah.
Yeah, okay. All right, thank you.
Just a question on the valuation of the sporting events. Say you bought a couple of tickets to, I don't know, say the SCG, and there's like 50 events a year that are on at the SCG. Do you have to allocate the valuation? Like if it's $5,000 for the seat, how do you value? Do you have to value it on a per seat is attended or just the events?
Sorry, so that's similar to like a gold membership for the SCG, that kind of thing, yeah. So we've got a lot of clients that have those. So what you would do in that instance is you would need to, and it's very, very difficult to track. This particular type of benefit is extremely difficult to track because they're basically entitled to go to anything that is held at the SCG or wherever that sporting event is. So you really do need to have a diary or some kind of tracking device where every time those tickets are taken out, a record is kept. And I worked with an organisation where we had gold membership to the SCG, and there was 4 passes, and basically we kept a record of who used those passes on each week because they literally were used every weekend for something. And then the hard part is then going through and working out, well, who used it a lot, who used it 3 times, who used it 20 times, in trying to allocate your... So it's not really just... You don't need to think about the actual cost of those tickets, which is like a massive amount. I think, I don't know, it can be 1,000 or 5,000, whatever. It's more about the individual events that they're attending.
I had one extra question on superannuation with sole traders. If we happen to work for an organisation where people might actually get paid quite a lot of money and say they work for you a couple of weeks in a quarter, they would breach that super guarantee limit and therefore then they would then go and work for someone else. How is the super cap for the sole trader meant to be managed if the organisation that is paying their services has a requirement to remit 9.25% of the invoice?
So on that, basically what it is, so you're correct, a lot of people are saying why you're paying superannuation, which is for sole traders. The definition for employee is much broader than what it is under your general PAYG provisions. Under Superannuation Guarantee, there's a specific part that says it also captures contracts that are wholly or principally for the labour. Now, to be an employee, you have to be a natural person, so that kicks out your contractors that are trust partnerships or companies. So it brings it back to sole traders. And if you do have sole traders that are there predominantly doing day-to-day duties, question is, are they really an employee? That's a whole different argument. But if they are legitimate sole traders and they are there providing their labour, then you are correct. So the first point of that, yes, you do have superannuation. You've got 2 things. Legally, you only have to pay superannuation up to the maximum contribution base, unless you're contractually obliged not to. So your contracts might say, we will pay 9.25% on your total invoice. If it doesn't say that and it just says, we'll pay it in accordance with Superannuation Guarantee Administration Act, then you can cap it at that maximum contribution base, and that's well below what the $25,000 cap is. The other problem, we have this a lot for directors that work for several companies. It can mean that when you work for several companies, if you're not capping at the maximum contribution base, they will go over their $25,000 cap. The employer is legally required to pay that. It's just bad luck for the employee, and directors have this problem. The new changes that came in 1 July 2013, which a lot of employers probably won't be aware of because it's more on the individual, means that the individuals can now get their money back because it's actually going to run, all the excess contributions are going to go through their personal income tax returns, and they can actually apply to the Commission of Taxation to get 85% of that excess back, subject to an interest penalty. but it does actually mean that they can start getting some of that cash back now, but it will be back onto the individual to do that. Not sure how they're going to. Anyone that gets a super fund statements within 12 months of the end of the year is probably lucky, so I don't know how they're going to be able to give that information to the tax office to get it into your taxable income within the individual lodgement times. So I guess first part of it is just in a summary, because I know it's quite a lot. Sole traders, yes, you probably do have a superannuation contribution for. We get that a lot. It's probably the biggest thing we see in the marketplace that are not doing. Easy picking for the ATO and the OSR, first things they'll look at. The second thing is have a look at what your contracts say. What is that upper limit of the amount of superannuation you have to pay? If you've got a contract that just says we're going to pay you X per hour and you're not currently paying them superannuation, you've got that argument of can I carve that out of their hourly rate, or do I have to pay in addition? Whose obligation is? You can't contract out of that. The third one is if you're paying them a large amount, then yeah, they're probably going to breach their concessional contribution cap.
Can I ask Glenn, and it's really going back to that question on the rewards, ad hoc versus planned, what's the ATO looking at in relation to proving those types of, where people have used the minor benefit for a reward, what's the ATO looking at to determine whether it's ad hoc or based on a KPI?
Yeah, just looking at what procedures are in place to talk about those awards, how often particular people might be getting them. They'd be the two main things we'd look at.
Okay. So I've got another question. In the future, will the ATO also extend the payment dates as it has done with the lodgement date to late June? It's very hard to accurately calculate the FBT liability by the 28th of May.
Yep.
Don't complain. Don't complain.
Yeah. When we get a crystal ball, we'll lend it to other people. Yep. Yeah, that's something that does come up, probably gets mentioned every year. And one of the issues around that is that, like a lot of other places, the ATO needs to finalise accounts by the end of June. And that's one of the reasons why that May date is sitting there. It's for lodgement. And quite often employers do make a guesstimate and make a payment in May and have to get some money back. So you're probably better to overpay by a little bit than to underpay or not pay at all.
Can I just add something to that? This is probably not right on point, but I think it's worth making, and that is that where employers are using the extended lodgement program of tax agents, what we're finding every year, this is a problem we have every year, especially with the large corporates, is that the pay office requires the reportable fringe benefit amount information a lot earlier than 25 June. It's usually around mid-June that we get this crazy sort of phone calls every half hour saying, we've got to get the FBT return finished today. So I just urge you, for those of you that are FBT preparers, or if you are communicating with the FBT preparer at your organisation, to make sure that they liaise with the pay office and that they're both in sync as to, you know, when all the data needs to be finalised by. So they actually work towards the same compliance timetable.
I concur with that.
On the question of FBT return and lodgement and refund, I went to a seminar earlier this week where we were advised, Glenn, I'm interested to know your opinion, we were advised to actually underpay our FBT and lodge rather than overpay, because we were told that refunds were creating questions from the tax office over why a company deserved a refund. What's your opinion on that?
It was a payroll tax thing, wasn't it? That was more payroll tax thing.
No, we shouldn't look a gift horse in the mouth. So, yeah, no, we don't chase that sort of thing up unless there's some odd amounts gone through a wrong account. That might be one reason why we might ask why that's in that account. But if it goes to the right account, particularly when there's a payment made at that time in May, we normally wouldn't ask any questions.
Yeah,
I was just going to say,
I've heard that. I've heard that for payroll tax as well.
We've actually seen it. I'll let Ian speak, but we have seen it a lot. That if you do end up with a significantly large refund in that annual reconciliation for payroll tax, it can spark an audit.
They're not happy.
Yeah.
Are they, Ian?
We have an automatic audit if a refund is over a certain amount, and that can slow up the refund. But refunds below that amount generally paid automatically unless the client has a history. That's for me to know and you to find out.
Is it $1.80
Once you're
still?
audited.
Is there another question?
Excuse me, can I ask a question about the contract and the contract agreement? Our business departments have service agreements with a certain external consultants, and for us, actually, we have no idea if those external consultants are working by themselves or not. They do not provide the services in the office. They go around in Australia. In this sense, then how can we? Do we have the obligations to? And in every time when we sign up with the consultant for service agreement, we need to ask if he's only working for us, and if he has 2 more staff to work, or etc. How can we tell? Should we find out if the consultants are only working for us and can be categorized as contractors or not? Thank you.
You do need to keep records of the basis on which you claim an exemption. So, if you believe you're entitled to an exemption, you need to get some information from the contractor. And I know it can be difficult, but if they're providing services to a number of other clients, then you need to get some verification of that. Or if they're using 2 or more people to provide the services to you, and you can't tell because they may just provide a result, then you also need to get confirmation. We have accepted stat decks from contractors. The contractor provides a statutory declaration to the employer and keeps it on their records until, or in case they're audited. If we do an audit and you have assumed that someone is exempt but you don't have proof, we can check through BAS returns. If a contractor, you're paying a contractor $50,000 and their return to the tax office shows they've got income of $100,000 or $200,000, then we will accept that they're providing services to the public generally. If their BAS statement shows that they're paying wages, we can determine from that whether they're employing other people.
Ian, just practically, I mean, we have this is a problem we all have, especially those that have a lot of these types of contractors, in that you've got that extra advantage where you can go to the BAS and suss it out. I mean, you know, unless we do a hell of a lot of research around a particular contractor, we sometimes have to accept whatever's in the declaration or what they tell us. So I guess my question, adding to that, is like, how far really do we need to go now in order to be able to apply these exclusions? Because it's getting harder and harder. And you know, I've had clients that are undergoing audits that have a lot of contractors, and it's almost a full-time job every time a contractor's engaged to really work out what we're going to do about these exclusions.
I accept there are difficulties, but we have to deal with them, and we don't assess people just because you haven't got proof. We will make our own inquiries. It's only when employers don't cooperate in obtaining that proof that we may just assess and leave it to the employer to come up with the evidence.
One of the things we suggest as well is when you're getting them to sign that first contractual agreement, have a checklist behind there. And I mean, it's very much the tax having to talk to HR or the division head or whoever's giving out that. But we've got certain questionnaires that we provide to our clients that say, you know, will you be providing more than 2 people to perform the services? Do you perform services to the public generally, you know, more than two other unrelated people, or more than 40% of your income? Just sort of questions like that, that when you're first doing it, and it is very much on intention at that stage, but at least then you've got that. And it's, you know, typically we find when you get audited, you're going back 5 years and you've got someone that's new in payroll going, well, I don't know why they did that exemption, or there's a file that just says we excluded these 19 people and no one has a clue why.
But I think
so
the
documentation.
reality is, though, that if they haven't given you the right advice at that point, you as an employer, you don't have access, other access to it. So 2 or 3 years down the track, when you're being audited, you're the one who's going to have to pay the tax and any penalties. So that's the difficulty around this, and how the employer can do a lot to try and avoid it, but at the end of the day they are relying on information from a person that may not necessarily give them exactly what, you know, the correct information.
A significant part of the problem is that the payroll tax return is generally undertaken by the payroll office. Contracts are paid through general ledger, and the payroll office may not get details of contractors. It's something employers have to keep in mind, and have a system that identifies when they pay a contract which is primarily for services, that they consider it as part of their payroll tax return. And similarly, in some businesses, remuneration is very sensitive, and the payroll department may not know exactly what the other benefits are being provided as part of a package to especially highly paid people. And in some cases we've found that payroll department doesn't know about certain payments that are wages, simply because it's a company secret.
Is there another question from the floor?
I've got a strategy question for you then. You know, with the new law firm that has come through, the relocation exemptions have not been affected. So then when employers are paying for the visa fees for their experts, which are to facilitate the relocation transport.
When the employers are paying visa fees to facilitate the relocation of an expat, that would fall under exemption. So the NTLG minutes of 15th November, where this question was asked, does it still apply that it is the timing of the visa application that is what we need to take into account to establish the annexes with the relocation, rather than whether it's a permanent residency application or a 457 visa? So are we still applying that exemption based on that minutes?
That's correct. Yeah, no, that's correct. Yes. So what the exemption is relocation transport exemption that we're relying on, which is separate and distinct from LAFA and relocation exemptions. So the problem with the relocation transport exemption was that sometimes, and it happened to me last year with one of my clients, is they've brought people over on a like a holiday working visa, and then once they get here, they decide they're either going to stay or they're going to go 457. At that point, it's too late. You cannot link the visa request back to the transport. So the visa request has to happen simultaneously and has to be part of the initial transport for them to get to Australia, whether they're staying or going back later on.
Yep, so the type is not going to really matter. So whether the type of visa
is not going to matter.
No,
so it can be for relocation or for LAFA.
Yeah, so it doesn't matter whether it was a permanent residency or not.
Yes.
Because I think there was a belief that if it is a permanent residency, automatically you cannot apply the exemption, even though it was applied at the time of to facilitate relocation transport. There was this belief saying, oh, permanent residency application is considered as a private nature and you cannot apply or attach it to a relocation transport.
No, and there's actually an ATO ID out that basically says if you do come over on a 457 visa or equivalent visa, then, 4 years down the track when that runs out, you apply for permanent residency, and the tax officer saying, well, you can't claim otherwise deductible, or you can't claim any exemptions for that because it's a private, it's not related to your work, even though you need that visa to be able to stay here to work. They're saying it's a private decision and therefore a private expense. So if the company pays for that private residency application, full FBT.
Okay, thank you.
All right, I've got a few more questions from the webinar. If I allowed an employee to purchase fuel in lieu of overtime worked, would that be subject to FPT? I don't make up the questions.
I think the answer is yes.
Yeah.
I think yes.
Is it yes? Okay, this is one about car parking fringe benefits. If a person who works in a shop located in a shopping centre parks their car in the shopping centre all day and there is a commercial car parking facility nearby, would the employer be liable for car parking fringe benefits? I'm getting lots of nods, so yes. So that one's answered. A payroll tax question. If contractors come to us via recruitment agencies or companies, can we easily exclude them from our review of relevant contracts?
No. Essentially, it depends if the employer is responsible for paying them, then the contractor exclusions would apply. But if the employment agency is responsible for paying them, then they would be subject to the employment agency provisions, and none of the exclusions would apply if they're a contractor. And if they're an employee of the agency, then the agency remains liable whether the end user is exempt or not.
Great. And I've got a question for the lady on the end, who I assume is Kylie. I'm not sure which end, given Donna and Mardi, everyone's female, but if I'm on this end, so you use a checklist for clients, including more than 2 clients or 40% of income. Where do those thresholds come from in the context of providing service to the public? Okay. I think maybe they're confused.
Yep, so I mentioned before that sometimes we're working with clients, we're working around that contractor provisions just to make sure, we do the assessment, are they really a contractor or should they be an employee? If they are a contractor, let's get some more data when you're engaging them just to see what sort of exemptions may be available. And one of the things we do put in there is if you go onto the OSR page, and Ian can probably direct you a bit better than I can, there are a lot of rulings around the contractor exemptions. And I think under the one where it says the contractor provides services to the public generally, and also under the Commissioner's discretion to apply an exemption, there is a lot of criteria in those, and there you'll find provides services. I think it works for you on less than 10 days on average a month, and they provide service to at least 2 unrelated entities. All that sort of criteria just purely out of the revenue rulings. And as Ian said before, that's New South Wales specific, but they are actually harmonised with most of the states, except for WA, who don't like to play.
All right, we're almost out of time, so one last question from the floor.
Just a question about commercial car parking. I understand there's some guidance from the tax office many years ago about the fact that a shopping centre itself would not be deemed to be a commercial car park. Does that extend, because they charge penalty rates obviously to get you in and out, is that extended to perhaps if a hospital is nearby and it is the only car park?
Yeah, yes, it is extended to a hospital, but the thing you've got to be careful with shopping centres and hospitals, and I'd like to see what my panel think of this, but just over the last few years I've noticed, for example, in Bono Junction, they've actually, one of the car parks there, it was just a shopping centre car park, has now, using the top floor and offering sort of all-day parking $10 a day, and people who work in the city go and park their car there and catch a train in. So that has changed things because that particular environment now is no longer just a shopping centre car park. It can be fall within the definition of commercial car park.
Yeah, absolutely.
I would actually ask the question then. So, for example, if it's in a total rural area and it's a hospital, and then all of a sudden Wilson's come along and go, oh, geez, we can make some money out of this, and Wilson's runs the hospital car park. Which clearly there's no other commercial car park facility around, but someone wants to make a profit. Would it be safe to say that is no longer considered to be a hospital car park, even though they're charging penalty rates?
Well, if there's an all-day parking rate, so forget the penalty rates. If they are saying, okay, but there's penalty rates for whoever comes in for an hour or two just to visit a patient, but you can also actually park here all day under an early bird rate, for example, or you can take out a monthly lease or whatever, for $15 a day, then yes, you do have a commercial car park and you do have an issue. Yeah.
Great. All right, well, thank you. I'd like to thank Glenn and Kylie, Donna and Mardi for their contributions this afternoon. I've certainly learnt a lot, and let's put our hands together to thank them properly. I'd also like to thank CCH for putting on these events, because I think that they provide a lot of opportunity for people to ask some wonderful questions and get some great answers from experienced people, so thank you.
Thanks very much, Fiona. So just before we wrap up, I'm Tony Katsigaris, Commercial Director in the Corporate Reporting Solutions Group. And sitting down here and listening to this, I've been involved in FPT for many years, and it fascinates me how such a small, simple tax, that's such a small pie of, I guess, our tax base takes up so much effort. And one of the things, I mean, often when we talk about FPT, we talk about the complexities of the technical rules. But today we've introduced, I guess, another element of that. So we talked about the Office of State Revenue of Payroll for New South Wales. Start multiplying that across all the other states. Start thinking about workers' comp, and I start wondering whether FPT becomes one of our most complex taxes amongst everything else. So it's just as well we've got a great panel that's there to help guide us and provide us with insights. It's great to have these events where you can network with your peers and actually share stories and ideas and learn from each other. And of course, coming from CCH, having CCH behind you that provides you with the knowledge and the tools and the events to be able to deal with all of these things. So thanks very much, everybody, for attending. And just as a small token of our appreciation from CCH, I'd like to thank our Chair, Fiona, our presenters, Glenn and Ian, and our commentators, Mardi, Donna and Kylie. And just a small token. Thank you. I was wondering all of a sudden where that last pack went. All right. So before we wrap up, look, thanks very much for taking the time out this afternoon. Before you move on, just a small reminder, if you could take a little bit of time to fill out the questionnaire that's in your packs. As you know, we do take the feedback on that very seriously, and we try and improve each one of these sessions as we go along. And I'd also like to draw your attention to the forthcoming events. So in June we have a series on GST, and then later in the year, in September, on profit shifting. So thanks very much, everybody, and good luck with the forthcoming FPT season, and look forward to seeing you next time. Thank you.